we've shown throughout history that it's very easy to create inflation. The trick is creating a little bit of inflation. That's actually it's not a dial that has fine markings on it. It's a dial that has on and off.
The Phil Bach Podcast. Investing, economics, entrepreneurship.
Welcome back to the Phil Bach Podcast. If there's one thing that we can all agree that we cannot agree on, it is inflation. Are we entering an inflationary period, a deflationary period? Is CPI accurate? Is it transitory? What's the impact? On this episode, we're going to get answers to every one of those questions and every other question that you might have about inflation. My guest is the inflation nerd himself, Michael Ashton. Michael has played an integral role in developing new instruments and methods for accessing and hedging various inflation exposures at several banks in his career prior to being the founder of Enduring Investments. He's also the author of the book, What's Wrong with Money? The Biggest Bubble of All. Michael, thank you for joining the podcast.
Hey, Phil, thanks. Glad to be here. I don't know if we have 36 hours to cover all those things and get all of the answers the way you want them, but we'll do what we can, right?
Well, the answers are transitory anyway, right?
Right. Everything's transitory.
The word of the night is definitely transitory. There are so many misconceptions about inflation. There's so much that I want to jump into. Let's start, though, with your firm, Enduring Investments. What does your firm do, and what is your investment philosophy?
Yeah, so our firm, Enduring Investments, was formed to be an inflation-focused investment management firm. And really, I guess I describe us as inflation plumbers. You know, if you've got something mildly wrong with your house, you might call a handyman. But if you've got a leak coming through the bathroom, coming through the ceiling, then you call a plumber. And so if you've got an inflation leak, then you really should call the inflation plumbers, because we're sort of experts in all the different ramifications, the different ways to diagnose an inflation problem, to treat the inflation problem. That's sort of what we do.
So a few weeks ago, when all the talk about inflation really started to bubble up, I tried to find the CPI basket. I was curious what was in it, if the Fed was intentionally putting things in or out to try to impact the measurement, or, what it was. And it sent me on this wormhole. I spent hours. I went down, I got sent to the BLS and was reading different papers and notices from them and just trying to figure out what is in CPI. And in the end, I kind of threw up my hands and said, you know what? I'm going to talk to Michael. I'm going to talk to you. So let's start here. What is CPI?
Yeah, if it was really super easy, then you wouldn't need the inflation nerd, would you? Inflation is, so CPI is a way to measure inflation, right? If we're talking about inflation, generally we sort of mean that, we understand that to mean that prices are going up in sort of some vague sense. And there are various ways to measure that. And the CPI, the Consumer Price Index, is one of the ways to do that. The Bureau of Labor Statistics, as you said, is the one who produces it. And essentially what the goal of the CPI is to figure out kind of what an average human being in the United States buys in a given year, and to look at all those different things and measure their changes, their price changes, and aggregate that up into sort of one broad general price experience, so that if you were to look at your entire market basket, all the goods and services that you buy in a year, and you looked at everything you bought this year, and assuming you bought all the same stuff next year, what would happen to the value of that basket? Now, if you obviously you will change the things you buy from this year to next year, and you're always seeking to improve your standard of living, but the Consumer Price Index is trying to measure what the price change would be if your standard of living was exactly unchanged. You bought the same stuff year after year. What did that stuff cost you year after year?
Okay. Do you think that it is intentionally opaque?
I don't think it's intentionally opaque. I think it's that it's just, it's a really complex problem, right? How many different things do you buy in a year? It's thousands of transactions. Go look at your credit card statement at the end of the year and your bank statements and all the things you pay for with cash. And there's just thousands and thousands of things that you have to measure. And so the more accurate you want to be, the more the more things you have to include, and the harder it gets to measure all these things. So there's something like 285 minor categories, low-level categories of the CPI, and they measure them in each metropolitan standard area in all these different regions, and they have to aggregate this all up. So every couple of years, they go take a spending survey. They go figure out exactly what people are buying, and they get this enormous long list of things and weights, and then they have to go and measure the price level of all those things. It's just a really complex thing to go and do. And that's why it ends up being opaque, is it's really hard to sort of see. And it becomes, because they're doing it that way, it becomes less intuitive. We don't have sort of an available heuristic in our lives to say, 2.2% on CPI, that sounds about right. There's no one thing that we're looking at, so it's very hard to tell if that's right.
Right. And you know, that's my next question. I mean, is it accurate? Does it accurately measure inflation?
You know, every person has a different experience of inflation. We actually have a tool on our website, enduringinvestments.com. And there's a tools menu, and it's personal CPI, I think is what we call it. And it just takes sort of 20 or so categories, larger categories. And there are a bunch of sliders, and you can sort of adjust those sliders to what you think you purchase in a given year. And by the way, that's a harder question to answer than you might think. How much did you spend last year? What percentage of your budget did you spend on a new car last year? There's not a number I know off the top of my head. Well, I know for me it was 0 because I didn't buy a new car last year. But you can go to the website and you can adjust these sliders, and it will show you what your inflation looks like relative to everybody else. Now, again, that's for an unchanged standard of living. And meanwhile, you and I are trying to improve our standard of living. So it's just a very, very difficult thing to go and measure. And I think that the BLS, I mean, it's all filled with lifer economists, right? So they don't have any dog in the fight other than to try to, they're academics. They're just trying to be accurate. And I really honestly believe they're trying to be accurate. There are some things that are hard to measure, like medical care. And there are other things that people debate about how you should measure. But I think that they have a very honest debate about it. And I think that they do a pretty decent job. And I think, by the way, you can sort of prove that they do a pretty decent job with sort of some, off the cuff calculations. And I'll give you an example, not to go on and on and on, but this is an example I like to give when people tell me that inflation is really 5% higher than the BLS says. If you look back to the early 1980s, 40 years ago or so, the BLS says that prices in the United States have roughly tripled. And the price index, the CPI price index has gone up roughly 200%. So we don't have any really good way to measure that because, Phil, I know what you were buying 40 years ago is very different from what you're buying now. For one thing, 40 years ago, you were probably not drinking mezcal. Or at least not good mezcal. But if you think back to what kind of an average wage was back then, and someone coming out of college in the early 80s, what were they making? And then kind of compare that to what someone coming out of college today is making. And whether it's 3 times or 2.5 times or 3.5, that's approximately right. And so at least the order of magnitude of the price change is approximately right. Because if inflation was really, instead of being 3% over that time frame, if instead it was 8%, compounded over 40 years, that ends up being just a massive, massive number, and would say that the kid in college, instead of having 1 roommate, needs to have 11 roommates or something like that. And we know that's not the case. So you can sort of get a general sense that the number can't be ridiculously wrong. It's clearly wrong, but on average, for an average consumer, it can't be crazy, crazy wrong.
I always see referenced core inflation, and I never really quite understood. How is core inflation different than median inflation or regular inflation? Why does it matter? When people talk about core inflation, what are they getting at?
It's great. People always say, why does the Fed look at core inflation? Don't they care? Don't they know we buy gasoline and food? And of course they do. And it's still in the overall CPI. But we look at core, which strips out food and energy, to get an idea essentially what we're doing when we take out food and energy is we're taking out all those super volatile things that over time tend to oscillate around zero. I mean, the overall level of gas prices goes up gradually, but if it goes up 100% one year, it doesn't keep going up 100%. And so we would kind of pervert CPI if we thought that was kind of a good representation. So things like the core CPI and median, trimmed mean, these are all ways to get at what the central part of the distribution is. And so this gets a little geeky, of course, but core CPI is a mean. It's a weighted mean. So we take all the different components and we multiply the price change by their weights, and that aggregates up to core CPI. But what that obviously does is if you have like one category that went completely bananas, a couple of years ago, it was cell phones on the downside. Cellular phone services just plunged because we suddenly got unlimited data and the BLS didn't have a good way to measure infinity. And so all of a sudden, core inflation plunged because it's an average. And so you take this big negative number and it pushes the average down. Whereas something like median or trimmed mean tries to get rid of those outliers and just focus on the middle of the distribution. But they're all trying to do the same things, which is, the basic idea is let's try to if we're going to try to figure out where inflation is going to go, let's try to get rid of the things which are mean reverting. Try to get rid of the things which had big changes because those tend to be the things which come back. And food and energy are sort of tend to be outliers a lot of the time. And so that's the reason that core was sort of the first attempt at doing that.
And what about PCE? You see PCE come up after CPI, and it's like, all right, well, is this better or worse? Like, why is there a secondary figure? How does PCE differ than CPI?
Yeah, so PCE, personal consumption expenditures, and so it's produced by a different arm of the government. It basically measures the same thing, but from a different perspective, and so the weights end up being a little bit different. So it ends up being more from the side of, you can sort of think about it as what people sell, what firms sell, whereas the CPI is what people buy. And so for that you would think that would be the same thing, right? Everything that someone sells, someone's buying. But when you look at it that way, you end up with a different answer for example, medical care. So when insurance companies, when a doctor sells medical care services, they don't sell it all to the consumer, right? A lot of what the consumer pays for healthcare, they pay through insurance. And so it's really the insurance company that's doing the buying, or it's the government. If you're in Medicare, the government does the buying. And so things like medical care are weighted very, very differently in the PCE. The Fed believes PCE is a more comprehensive measure. It typically is a little bit lower than core CPI. I don't think it's as good a measure personally as the CPI. It's less intuitive to me, but these are we're talking 0.5% plus or minus. It's a little bit. It gets to be counting angels on the head of a pin at some level. They broadly move together, and it's just a question of which flavor of ice cream you prefer. They're all cold.
Okay, so that's kind of the data set that everyone's working with. And is that what the Fed relies upon? Is that generally, do they have their own data sources? Do they rely on those data sources?
No, they generally rely on those. The BLS has an army of people doing this, and so recreating the wheel doesn't make a whole lot of sense. Although in recent years, there have been other efforts, independent efforts that used web scrapers, for example. There was the Billion Prices project at MIT that became the Price Stats, which is sort of independent. And by the way, comes up with roughly the same number as CPI. So, but it's different people. And so, ostensibly the Fed could come up with a way to go measure things themselves if they wanted to, but you have a bunch of pretty good measures. It would be sort of silly to spend a lot of time building your own measure when you have those. There is a limited, although it's hard to tell now, there is a limited budget for these things.
Right. Well, it's surprising that there is, because the stock market now, and the entire stock market has become, in my view, a bet on the Fed as much as anything else. The whole thing, right? The president of one of the federal banks sneezes and it's headline news and the market is jumping one way or the other. And it seems to me that the Fed has been trying to spur inflation for some time. And a little bit later, we'll talk about why they might want to do that. But I think there's a lot of paranoia out there that the Fed is understating inflation. And when you look at the commodities, you look at what's happened in timber and lumber, you look at, some of the day-to-day, we all see it. Look, we all see it. We see it at the gas pump. We see it at the grocery store. I think a lot of people feel like the Fed is understating inflation. Is that your view as well?
But I think those are showing up. I think they're showing up in inflation now. Furniture prices in the CPI advanced in this latest figure at 9% year on year, which is the highest since the early 80s. And most of that 9% was in the last couple of months. So I think that we're seeing those things come through. We have the highest core inflation now that just came out, highest core inflation in a quarter century. We had the highest month-on-month number, since the early 80s. So if they're trying to fake it, they're not doing a very good job. If you're gonna lie, it might as well be. Go and make it worthwhile, right? So I think that we are seeing those things. It does take some time for those things to be reflected in the surveys. You have to send people out and go and measure things. But look at used cars, for example. We've known for a while the Black Book is a survey of used car prices. And if you look at the BLS used car subindex, used car inflation subindex, it parallels Black Book, but with a lag of 2 months. So it takes a little bit of time from when Black Book knows about it to when it actually shows up in the BLS prices. So a lot of it, when we're trying to forecast these things, a lot of it's just sort of figuring out lags. We know these things are moving, and it's a question of, okay, how long does this take to actually show up? Now you've got some things, so long as let's talk about something that the BLS, I'm not going to say they're doing it wrong, because in a way they're doing it right, but something that we know is going to give us a different answer in just a few months. And that is the way they measure rents right now. So the way the BLS measures rents is they go around to ask landlords about a particular rental sample. And they ask kind of, which units are rented and what are you renting them for? And then they ask, okay, have all those units, what rents have you collected? And if you haven't collected rent, if somebody hasn't paid rent, then they ask, well, how much rent do you expect to collect? And if the answer is 0, then the answer is 0. And so at the end of last summer, the CDC said that thanks to COVID, you're no longer allowed to evict anybody. Eviction moratorium. So guess what? That meant that there were a lot of people, not a lot, but enough to make, you add in enough zeros, it doesn't take a whole lot to drag down a rental number. And rent inflation has clearly not gone up as fast as asking rents or home prices or anything like that. Now, is that wrong? Well, if you ask the BLS, they'll say no, because if you don't pay rent, that certainly means a lower cost of living for that person, which is absolutely true. If you want to lower your cost of living, just don't pay your bills.
I never thought of that option. Yeah.
But it's true, right? So, but when the eviction moratorium ends, then you're going to see that catch up. But that's one of the things. That's one of the reasons that core inflation is as low as it is. If you corrected for that, my estimate is that it's about that effect is worth almost a full % on core CPI. So you could see over the next 6 months, say when the eviction moratorium is finally kind of over and rents start to catch up, you could see instead of being around 3%, you could see core inflation around 4%. And I think everyone would start to say, yeah, okay, that's starting to feel more like it's a real number. So one of the reasons that people feel that the inflation is higher than the BLS is saying right now, getting back to the original question, which I always try to eventually do, is that you and I are paying our rent. And so we don't get that 0. And so the distribution of price changes is not even. Some people are clearly seeing a lot more inflation than other people. But we also, by the way, everybody feels inflation is higher than it actually would be if we carefully measured what they spent.
Yeah, and you look at asset inflation, right? You look at home prices, you look at stocks, you look at different assets, and then you look at the cost of living, right? The day-to-day stuff like food and gas and everything else, and it certainly feels like there's some sort of disconnect, and it ties back into the widening wealth gap. It's great that asset prices go up, and it's good for everyone, but it's especially good for the people who own assets, which is to say, rich people, right? Poor people don't own stocks. But they do have the same basic needs. They do have the same cost of a loaf of bread and a dozen eggs. So inflation by and large, I guess there's really two parts to that question. Is there a disconnect in the measurement? And, which leads into a whole, another question about how inflation impacts the widening wealth gap.
Yeah, no, they actually, the BLS has studied, and I forget whether they actually have a series that does this. They actually have studied how different income levels experience inflation, because clearly, to your point, it's different. If you're in the lowest quintile, you're not buying a new Tesla. If you're the upper tier, you're not buying day old fish. So there's definitely a difference in the market baskets, and that definitely leads to different inflation behaviors or inflation experiences at the different levels. And to your point on the asset side, by the way, this isn't just for the wealthy and the less well off. It's also true by ages, right? So I always laugh when young people are cheering on rising stock prices, because I say, well, you really want to help out your grandpa, because your grandpa owns all the stocks. You don't own very much. You're going to be buying stocks for the next 20 years. Why do you want high prices? You should want low prices right now. And so, every time the stock market streaks higher, it's making it harder and harder for the people who are just now starting to buy stocks. It's making it harder on them to earn returns in the future. I don't think people really get a good feeling for that. They just want everything to keep going up.
Everyone just wants the number to go up. Everyone just wants the stock number to go up. And I think I agree with you. I think rising prices are not, first of all, they're going up in a mark-to-market basis. It's a fleeting price. So an upward price today doesn't mean that we're going to still have that price tomorrow. So you get this temporary price bump, which makes like you said, assets more expensive to purchase. It only helps the asset owners, and it only helps them on a short-term basis, while the cost to push them up can sometimes be a lot more lasting. And the Fed for years and years have been trying to spur inflation, but they haven't been able to. Now we're starting to see it a little bit. Why do they want to increase inflation? I have a theory that, because the country has so much excess debt, if we have inflation, then it lowers the value of the debt that we owe. And it's really the only way to manage the debt that's gotten out of control. I don't know if you agree with that assessment or not, but, by and large, why has the Fed wanted to spur inflation?
That's a really good question, because it's, you can listen to what they say and they'll tell you something different than sort of some of the intuition might lead you to. So what the economists would say is that we want to have some inflation. We don't want to have a lot. We want to have some, because deflation is really, really bad for us. Now, we feel that way because we still have this institutional memory of the Great Depression. And the idea that you get these liquidity crunches, and you get caught in these deflationary traps where, because everyone knows the price is going to go down next week, they don't buy anything today. And so you can't stimulate anyone to go spend because they expect prices to keep going down. And so the Fed, and by the way, I think it was Australia's central bank that decided 2% was the right number. But somewhere along the line, they decided that having a little bit of positive inflation is a good thing. And so when it gets low, it gets kind of droopy, like it's been, 1.5% or whatever, all these people at the Federal Reserve, who by and large are quite wealthy people, they've done very, very well, and they don't have quite the same feeling for this 1 or 2% inflation thing that you and I do. And they get concerned that we're about to slip into a deflationary spiral. I think that's absurd. I think it's very. We've shown throughout history that it's very easy to create inflation. The trick is creating a little bit of inflation. That's actually it's not a dial that has fine markings on it. It's a dial that has on and off. And so, if you want to create inflation, do what they did in Germany, do what they did in Austria and in the post-World War I, and just print a whole lot. And you will absolutely get inflation. You won't get inflation you like. You'll get a whole lot of inflation. So there's not really a problem. The problem is, how do you nudge it from 1.5 to 1 3/4? And the answer is, you can't do that. You just don't have that kind of control. And it's sort of silly to worry too much about those sorts of things. And it's not clear that we measure it that accurately. Into all of our earlier discussion, I mean, there's some slippage in this number. So saying, we're targeting 2%, and it's at, 1.4. Oh no, come on. You can't be that. You're not sure that you're that accurate. You can't reject the null hypothesis that you are at 2. So it's sort of silly. I don't really think that the Fed wants to create inflation to get out of the debt overhang for a couple of reasons. I find that hard to really believe. One of the reasons is that, you have to create not only a lot of inflation, but a lot of inflation really fast to have it work, because the government's always rolling over its debt, right? And a lot of it's very short term. It's, 5 years and in. And so, you have to create the inflation really quickly because it gets reflected in interest rates right away. And moreover, a lot of the debt that the government has is implicitly inflation linked. The Social Security, Medicare are effectively inflation linked, and that's trillions upon trillions upon trillions upon trillions of debt. You can inflate away all the bonds in the world, and you're still left with 40 trillion in debt that you're just not going to get away from. So I don't know that there's any good winning strategy to inflating that stuff away.
Well, they claim that they have the tools to manage inflation. That's essentially the words that they use. But these same tools have been unable to create inflation for all these years. And, we talked earlier, the way I see inflation, and you know better than me, but the way I see it, it seems like a slow-moving train, right? You can't stop it. Like, once it's going, it's a train. It's moving pretty fierce, but it moves very slowly, and it takes time. And once you turn that train around and it starts going in the other direction, it's not that easy to just turn it off. And you look at what happened in Venezuela, and I'm like, oh yeah, that can't happen here. This is America. That can't happen, right? But it can happen, right? Why can't it happen? We're not going to print to the same level, but
we are, right? So we've got, money supply is going up, but it's down to only 19%, but it got up to 26% year on year for M2, which is double the level it was in the 1970s and comparable to what you see in third world nations. So we are trying to do that, and it's madness. Does the Fed have the tools to adjust inflation? Maybe not as finely as they want, but to move it? Sure, they do. Do they know how to use them? They haven't the faintest clue. There aren't very many monetarists left at the Fed. They don't really know how to do what they're doing. And by the way, even if they knew how to use them, I don't believe they have any will. I believe that they have will to increase the money supply, to push asset markets higher, to add some consumer price inflation, but are they going to be willing to pull away the punch bowl and watch stock prices drop 40% because they think because inflation at 3.5% bothers them? Yeah, good luck. Not a chance.
They won't let stocks drop 2%.
Absolutely. And there's no chance in my mind that the Fed is going to do anything aggressive to rein in inflation if doing something even, like you said, everyone's watching any indication from the Fed. If they so much as if Powell rubs his nose the wrong way in the press conference, the stock market drops 2%. It's inconceivable to me that the Fed is going to do anything necessary, anything that would be necessary to rein in inflation, even if they knew how to do it, because they don't have any interest in watching stocks go back to something approximating, the sort of values we used to see.
I got a question from John LaRose, my colleague at Signal Advisors. We're finally seeing wage inflation, which I think is great. I don't know, maybe there's something I'm missing, but I think that's the kind of inflation that we can all be happy about. The question is, what would rising wages mean for longer term inflation?
Yeah, so there's the question of the feedback, and I think you have the direction right. So I think that we tend to see wages follow inflation. If wages generally went up first and then we saw inflation, then we'd all love inflation, right? Because our wages would always be ahead of it. But we know that wages tend to follow it. Right now, we're seeing actually wages go up in advance of inflation in some places, just because of some really weird COVID-related things that we're having to like lure people back in. And actually, if you look at the Atlanta Fed has a wage growth tracker, and that they break up into high wage and low wage, and high skilled, low skilled workers and whatever. And inflation for the low wage workers is where it's really you're seeing some pressure higher. And that's great if you have equality or equity or whatever they call it these days as a core belief, which I'm not sure is a core belief that the Federal Reserve or the Treasury should have, but it's what they say they have. And so if the wages are pushing up from the bottom and decreasing that income gap between the high and the low paid workers, then I guess that's good at some level. What does it mean for inflation going forward? Well, here's I guess something that's I don't know. This is a correlation, and whether or not there's causation, I'm not 100% sure, or I'm not sure which way the causation runs. But if you plot unionization rates in the United States against the inflation rate, you'll see a very good correlation. So when inflation is high, you tend to have lots of unionization. And when inflation is low, you have very little unionization. Now, that could work both ways, right? So it could be that when you have lots of collective bargaining, that tends to mean higher wages for workers, that causes higher inflation. Or it could mean that when you have higher inflation, that creates more incentive for collective bargaining so that those wages keep up. Either way, it's sort of a feedback loop. It works both ways. When inflation goes up, then there's an incentive to argue for higher wages. And when those wages go up, it's increased cost for businesses and makes it harder for them to hold the line on prices. And so it's cost to them, and they have to push their prices up. I don't know which is first, the chicken or the egg, but there is a feedback loop that goes there. And once it starts to go, that's one of the reasons that people say they don't worry about inflation until they see wages go up, and then they believe there's this reinforcing cycle. Again, I don't know if it's reinforcing, but there's definitely a correlation there.
All right, so let's get to where the rubber meets the road, where people are listening, or I'm sure screaming at their radio, their iPhone, whatever they're listening on. What do I do about it? Right? How do I protect my portfolio, or how do I try to take advantage of it and profit from it? So let's hit a quick lightning round of different assets or asset classes that people talk about as potential inflationary hedges. I'll start with TIPS, Treasury Inflation Protection Securities. What do you think? Does that really cover inflation?
Yeah. So, obviously TIPS pay CPI inflation. So if that's not your inflation, it won't hedge you perfectly. TIPS are longer term bonds. I mean, you can get them very short term, but if you own a 10-year TIP and you hold it to maturity, it's a very good hedge. If you buy a 10-year TIP and over the next 3 years, you get a lot of inflation, then what happens is the interest rate on the TIP also goes up. And just like any old bond, it's going to lose a mark to market. And so longer term TIPS tend to have not a great correlation with inflation, actually. Shorter term TIPS have a much better correlation with inflation, but if you hold them to maturity. So a TIPS fund is not necessarily a very good hedge because you never get to maturity. Individual TIPS, if you hold a ladder of TIPS, that's actually a pretty good hedge. By the way, while we're talking about TIPS, because I know you're not going to ask me about I bonds, which is the treasuries, the savings bonds that are inflation linked. Those are actually phenomenal investments. Unfortunately, you're limited to only, I think, 10 or 15,000 per person per year or something like that. So you're not going to invest your entire hedge fund in it. But they're a tremendous deal because the real interest rate on those is, because the way they do it, can't go below zero. And right now, real interest rates are negative for all kinds of TIPS.
All right. The next one's a bit of a lightning rod. Not quite as much as crypto. We'll get there. But gold. Is gold an inflation hedge?
Yeah, so it turns out, there was a great paper written a few years ago called The Golden Dilemma. And it went through all kinds of different myths and beliefs about gold. So, and recently I've been studying this a lot because a company that one of Enduring's clients is a company called Simplify ETFs. I know you're familiar with them, Phil, and they've been working on a product related to gold and commodities. And I can say that because it's out of registration already. So it's just a question of when it launches. But so it turns out that gold is if you hold it for a long time, it's a decent inflation hedge in that it will tend to go up roughly with the price level. Okay, but people tend to think gold has this huge levered effect with inflation, and it doesn't. Over a long period of time, it goes up about what the price level does. Unfortunately, it has a humongous sensitivity to real interest rates. And so if you plot like the 5-year real interest rate against gold prices, you have a ridiculous fit. And so that's not good. When inflation goes up and you have, you're going to have, and so you have, real interest rates going higher, then that actually means gold prices are going to go lower. And so you actually get not necessarily a great effect there. So I think gold should be a part of most portfolios for its diversification. And because in the long run, it's a pretty good hedge, but for the short term, it's not a very good hedge.
What about various commodities? And we're seeing right now such a price dislocation, with lumber running, copper's running, some are, some aren't. They seem to be all over the map, but they are certainly levered against inflation, at least from what I can see. Is that the way to play inflation?
Yeah, so I think a broad-based commodity index, or again, the thing we're working on with Simplify, will be a narrower basket of commodities that have very good betas with respect to inflation and inflation expectations. Some commodities are better than others, but you can certainly do lots worse than having a broad basket of commodities. A commodity index like that actually has a good correlation with inflation and keeps up with inflation in two different ways. One is that early in inflationary cycles, you tend to have the prices of individual commodities tend to shoot higher, which is what we're seeing right now. But also you earn a collateral return, and over time, the T-bills that you own to collateralize your futures index tends to move with inflation. So you kind of have these two things which tend to mean good correlations and decent returns. And right now, I think commodities, even though they've run up a lot, they're still way cheap. They've gone down for so long that they are so much cheaper than other risky assets like stocks that would probably be my go-to right now.
And what about real estate?
So, let's look at two different ways. So there's commercial real estate, and then there's residential real estate. So residential real estate, which doesn't earn any real return, over a long period of time, again, roughly keeps up with the price level. Actually, Bob Schiller noticed, or he had one of his articles a number of years ago, pointed out that we know that housing must do roughly the same as the price level because there are houses in Amsterdam. We have prices going back to the 1600s. And any sort of compounding over 400 years that is not the same as the price level would mean that these houses were either essentially free because they compounded at less than inflation, or they were unachievable by, unpurchasable by anybody because they were way too expensive. So we know that residential over a long period of time roughly keeps up with the price level. Right now they seem expensive, but it's a good hedge. And so if you're elderly, if you're retired and you own your home, you have a good inflation hedge for the long term. Commercial real estate, a little bit different. It gets its returns a different way through rents. Rents tend to be much more positive, are positively correlated to inflation over the long term. However, the value of commercial real estate acts kind of like stocks. And when inflation goes up, the multiple that you earn on commercial real estate tends to go down.
All right. I want to save a little time because I want to hear about Enduring Investments and a little bit of your story. But before we do, we have to step on the third rail. Crypto is the biggest story right now in the markets. We're recording this. It's May 20th, 2021. We just had this amazing crash and rebound in the crypto markets. Many people in the crypto markets will tell you that it is, in fact, an inflation hedge. What are your views?
Yeah, so we didn't publish my address with this, right? I just want to make sure. So, it used to be that you didn't want to say anything about gold because the gold bugs would kill you. And the gold bugs look like it's just like completely tame compared to the crypto maniacs. Look, I think the technology behind crypto is whiz bang. Love it. It's fantastic. At the end of the day, the argument is that fiat currencies are bad, so we need to have something the government doesn't control. Well, okay, but crypto is also fiat. Fiat just means that it gets its value because I believe it has value and you believe it has value. Crypto they can have high values because the supply of them is relatively restrained. And if the demand of them is high, then they can have very high prices. Conversely, if nobody wants it, it goes to zero. If you can't use it to buy your Tesla, then all of a sudden the value of that currency, because it's not worth anything as a medium of exchange, it doesn't kind of go to zero. It goes to zero like instantly, right? So it's that's the problem. You have an extremely volatile foreign exchange rate is what it is. So Bitcoin or Ethereum to dollars is just an exchange rate. It's just a really, really volatile exchange rate. And that's the way I think you should think about it right now. It's a very, very volatile exchange rate. And if you think that there's less inflation in that Ethereum currency, then sure, it should outperform the dollar over time. Should it outperform it by 400% in a year? Probably not. It probably sounds like a little bit too much. And we'll do another 400% after that. Seems a little I'm a little skeptical. And at the end of the day, it's just lots and lots of volatility. And I think it's still a speculator's game.
Yep. Okay. Let's talk enduring investments. So tell me about the firm. Tell me about how you got started. How'd you get off the ground? How'd you get out of the corporate world and on your own?
Yeah. So I was on the street for many years, all the big bulge bracket places, Bankers Trust and JP Morgan and Texas and Barclays and several others. And, which you could take to mean that I couldn't hold a job, but that's neither here nor there. And so I was an options trader and I was a strategist for a while and an options trader. And it was a soulless kind of thing. I was at Barclays. I was trading gamma, so short-term options. And that's just a good way to lose a lot of hair and die young, especially when, hedge funds are calling in every day and just want lots and lots of 1 month, 4-year vol. And you're like, why am I doing this? What societal purpose am I serving? And then I was at Barclays and they asked me to sort of move over and trade inflation. Inflation derivatives had gotten started in Europe. They weren't started in the US. And they said, we need you to make this market, create this market out of whole cloth. And I did. And it was a watershed moment in my life because this was something people really needed. And they needed inflation protection. Inflation derivatives were one way to do that. And I was good at teaching it, telling the story. I was doing something good for society. So I moved over to it and never looked back. The problem is that Wall Street's not very good at doing fun, niche kind of things. They want to trade billions and billions of headline inflation. And I want to trade college tuition inflation because, Phil, at the end of the day, you don't care about CPI so much. You've made that very clear. However, if I told you I can hedge your long-term care inflation costs for when you're old and gray, or if I told you, you've got kids growing up and I can hedge their college, you just have a newborn and I can hedge what it's going to cost them to go to college in 16 years or 18 years or whatever. That's interesting, right? So that's got much more salience. Problem is Wall Street has no interest in doing that. So I left the street in 2009 to form this company. That was part of the idea, was that by being specialists in this very niche area, that we can offer people better ways to hedge. Again, we can be inflation plumbers. And we also can be the experts in how to trade. What's a better way to put together a global inflation-linked bond portfolio? What's a better way to trade commodities and things like that? And so that's how we formed the company way back when.
And when you started, has it been smooth sailing from day one? Did you experience any pivots?
Yeah, well, so yeah, I did say 2009. So let's look at the inflation chart from 2009 until last year. And it's really done nothing. And I will say I did not appreciate, how my attitude has always been, look, we are not establishing this firm because we think inflation is going up. Because if we do that, it's not a company, it's a trade. We have to help people manage risks. Sometimes inflation goes up, sometimes it goes down. Okay. The problem is when inflation isn't going up, nobody cares about the risks. And so it turns out that it's really hard to sell that product. And also, it's hard to be a startup, period. And a startup with a smart idea, difficult. And so it took us a long time to sort of figure out that trying to start a fund or a couple of funds or dealing with, large multinational insurance companies or sovereign wealth funds or whatever was a really hard way to start things up, and creating a fund to do something like that was almost impossible. And that what we really had to do was think about ourselves as sellers of intellectual property. And so we're not selling a fund. We might launch a fund to profit from our intellectual property, but we also might license that intellectual property to somebody else to start a fund, or use some of our understandings to consult with somebody and earn revenues that way. And so understanding that our product was not necessarily a financial asset, but was the intellectual property was sort of the biggest, I think, pivot. But at the end of the day, it was still a very difficult thing to do until people started worrying about inflation.
Which they are now. And I think, you've built a really strong base to work off of, and hopefully you're in the right place at the right time now.
Yeah, I hope so.
Well, I like to ask this question as my closing question of every guest, which is, tell me an obstacle that you've had either in your personal life or your career that you either found a way to work around or persisted through.
Yeah, so I'm a redhead. No, I'm not going to go with that.
I am as well.
Yes, everyone always says, beaten like a redhead stepchild. And I always take objection to that because I am a redhead stepchild. But no, I getting back to what we were just talking about with the enduring challenge, I think that one of the things that, and this firsthand, I'm sure, is that, our industry is biased against small firms. Now, we can do almost anything a big firm can do, and we can do lots of things that a big firm can't do. BlackRock cannot offer college tuition inflation hedging. Okay, we can, and because we know how to do it, and they don't. And so, but it doesn't matter at some level because if you're CalPERS or you're the central bank of Sweden or whatever, you're much more comfortable dealing with BlackRock than you are with us. And so we had circumstances where we would go talk to a big institutional consultant and tell them about a neat thing we were doing, say with tuition. And a couple of days later, a friend would call from a big asset manager, say BlackRock, and say, "Oh, we heard from this institutional consultant, and they wanted to know if we could do tuition inflation." And we said, "No, but you should talk to enduring investments." But so there's this big resistance to doing big business with small firms. And so the way we have addressed this, the way we kind of met this challenge again was sort of going and saying, okay, there are some advantages I have as a small firm, and that's that I can move quicker, I can design things on the fly, I can think faster, I can do research and roll out products quickly. And there's some disadvantages I have, and that is I have no distribution at all. So how can I leverage big firm distribution with the advantages of a small firm? And that's, again, the epiphany that I came to was your product is intellectual property. And so how you distribute that intellectual property is not as important. I'm sorry, the distribution is important, but whether or not the product is a fund or somebody else's fund is not as important. It's not important that I trade the tips. It's important that I have the idea and that I'm helping an investor, a customer, directly or indirectly. It's my idea, and that's where we're earning the rents, is on that kind of thing.
Well, that's great stuff. Mike, thank you for joining the podcast. Appreciate your time. Where can people get in touch with you? So on Twitter, you can follow me at inflation_guy, or you can go, if you want to contact us, obviously, then enduringinvestments.com. Go there and you can fill out the contact form, and I'm usually the one that gets right back to you. And that's probably the easiest way to do it. Yeah, full stop. All right. Well, thank you for joining the show. Thank you to the audience for your time and attention. I hope we made it worth your while. Please rate, share, and subscribe the podcast if you're so inclined. We'll be back next week.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.